Welcome back to Alpha Recap, your quick debrief on the market moves that mattered today. We're coming to you after the close, and as always, if you have questions, you can reach us at stockalpha.ai.
Good to be here. Markets closed up modestly today overall, but the tape really felt concentrated. A few big themes drove most of the noise.
Totally. Today felt like a three-act play. AI hardware signals getting real, earnings showing top-line strength but margin angst, and Megacap leadership masking some breadth questions. We'll dig into each one.
Let's start with the AI supply chain story. It was one of the day's clearest takeaways.
Right. Poet Technologies announced something that analysts called a step change. Not just a demo, but actual commercial progress. They disclosed a $50 million LumiLens order and said they have more than 10 engagements across their optical interconnect stack. That's the kind of detail that suggests moving from R&D into real revenue.
Yeah, and they also noted about $429 million in cash on the balance sheet, which is relevant because ramping manufacturing and integration takes capital. So that runway matters.
To make this accessible, optical interposers and photonics matter here because copper gets physically cramped at very high data rates, roughly around 800 gig. So as GPUs and memory demand more bandwidth, optics start to look less experimental and more necessary.
I mean, when you step back and look at this, that's structural. If AI workloads keep scaling, some parts of the hardware supply chain have to industrialize. Poet's order is a concrete example of that.
Short reaction.
Big move.
Now, the second headline today. Earnings season kicked off with a classic mix. Good revenue prints, but cost pressures showing up.
Delta's quarter was a great example. They reported adjusted second quarter earnings per share of 1.56 on about $17.7 billion of adjusted revenue.
Exactly. Top line looked strong, and management said airfares might stay higher, which implies pricing power. But, and it's a big but, they also absorbed the largest quarterly fuel bill in their history. That's a real margin headwind.
Right, so revenue resiliency, coexisting with cost stress. That pattern showed up outside airlines too, particularly in semiconductors, where input costs and capital cycles are key.
The chip sector softened ahead of some big semiconductor reports, including Intel. Traders trimmed exposure, and that knocked around supply chain and capital-intensive names.
Short reaction. This was expected, honestly.
Okay, let's talk about the market structure side. Megacap leadership versus breadth concerns.
Apple and Alphabet were at the center of that. Apple pushed into a roughly $325 patch, though it barely moved intraday, only about 0.06%. Alphabet's rally got reinforcement from positive commentary on execution.
So the indices looked okay because these big names held up. But analysts flagged valuation signals. Remember the Buffett-style gauge referenced in coverage? It spit out some historically notable numbers, which has people asking whether concentration is hiding deeper market risk.
Yeah, there were figures mentioned around 3.68%, 1.82%, and essentially 0.01% in that context. Little flags that make allocators pause and think about exposure sizing.
It's the classic question. Are we in a narrow market where a handful of winners carry the index? Or is breadth actually healthy underneath? Analysts are still debating it.
That debate ties into product innovation in indexing. Subversive Capital filed for what people are calling ex-Elon ETFs, funds that explicitly exclude certain high-profile names.
The name is catchy, but the point is real. Passive exposures aren't static. New ETFs can change flows and weighting dynamics if they scale.
Short reaction.
Right.
Yeah, that tracks.
Let's walk through the 4 cross-cutting themes the coverage kept returning to. First, AI is moving from narrative into supply chain reality, which we already started on with Poet.
Second, earnings season is increasing dispersion and post-report volatility. We saw examples where names spiked double digits intraday based on reports. One representative name was up about 11% during the day in an extreme case.
Third, revenue resilience often exists alongside margin stress. Delta, again, is the prime example. And fourth, Active management, index innovation, and valuation reassessment are all very much alive.
On active management, Kingdom Capital Advisors put a spotlight on repositions in the quarter. Their value composite returned about 11.97% net in the quarter, and about 20.94% year-to-date, versus about 22.57% for the Russell 2000 total return benchmark.
That shows selective, valuation-driven plays can still perform, especially when managers find idiosyncratic catalysts like patent wins or regulatory rulings.
Speaking of patents, the coverage mentioned a decisive European patent ruling for an infrastructure specialist. Those kinds of legal outcomes can really change a company's competitive moat and valuation path.
Let's pivot to the debates we'll be watching going forward. There were 4 big conflicts flagged.
First, growth leadership versus valuation risk. Do you chase megacap momentum or respect valuation signals and trim risk?
Second, structural AI optimism versus secular capex cyclicality in semiconductors. Is this a multi-year structural upgrade or a cyclical capex spike that will ebb?
Third, revenue growth versus margin durability in cyclicals. Delta again illustrates that top-line strength can be masked by input cost swings.
And fourth, passive concentration versus targeted exclusion. Those new ETF filings challenge the idea that passive is always broad market exposure.
Okay, digging a bit deeper on Poet. The $50 million Lumilens order is material because it's a binding commitment, not just a pilot. Combine that with about $429 million in cash, and you get the sense that they have runway to execute a manufacturing ramp.
Technically, the physical constraint of copper at those very high link speeds is the reason optical interposers are strategically significant. If that bottleneck is real, the economics of GPU to memory connectivity could shift materially.
For airlines, track unit revenue, yield, and fuel per passenger. Those metrics determine whether pricing can offset fuel volatility over time. Management said higher airfares look likely to persist, but that only helps margins if demand holds.
On megacaps, Apple's move into the $325 area and Alphabet's steady execution underpinned the overall market. But analysts caution that valuation gauges suggest a measured approach to exposure sizing.
And for active managers and index watchers, filings like the ex-Elon proposals plus selective manager repositioning mean capital allocation is evolving, not static.
So what does all of this mean for different investor types? We can't give personalized advice, but we can outline what the day's data suggests.
Short-term and event-driven traders should expect elevated post-earnings dispersion. Beats are being reevaluated against forward guidance, so stocks can swing sharply.
Long-term allocators, structural AI trends, and mega-cap revenue leadership support a quality growth tilt. But valuation signals argue for rebalancing and risk budgeting. Keep an eye on breadth.
Value and active managers. The day's letters and patent wins underscore that undervalued, execution-led small caps can be fertile ground for active returns.
Index-aware and passive investors. The proliferation of alternative ETFs that exclude certain names could change passive flows. Monitor product adoption.
Sector specialists. Airlines need to reconcile unit revenue and fuel trajectories. Semiconductors should watch inventory adjustments, capacity guidance, and capex cadence.
A few tactical considerations the coverage suggested. Prioritize catalyst calendars. Big earnings, streaming names, banks, and even medical conferences can move the tape.
Also, focus on execution metrics, not just headlines. For hardware suppliers, binding orders, cash runway, and supply agreements are more informative than press releases alone.
And hedge for dispersion if protecting multi-asset portfolios. Post-earnings volatility and concentrated leadership argue for diversity or hedging. That's a market observation, not advice.
Monitor ETF filings too. Product innovation can re-weight flows over time and change who benefits from passive allocation trends.
Before we wrap, let's pull out 3 quick takeaways from today's coverage.
1. AI is crossing the Rubicon from story to supply chain commercialization. Poet's order is an example of that shift.
2. Earnings season is creating more dispersion and choppy post-earnings action. Good prints no longer guarantee calm market reactions.
3. Revenue strength often sits alongside margin stress. Delta's record fuel bill illustrates the tension between pricing power and input costs.
Final thought. Analysts note that today's headlines blend durable structural change with event-driven uncertainty. Data suggests pockets of lasting change, even as valuation and cost realities counsel caution.
If you want to dig deeper into any of the names or themes we covered, remember, this is informational only. We're not providing personalized investment advice or recommending any specific buy or sell actions.
All right, that's a wrap. If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
Thanks for listening. Catch you next time on Alpha Recap.